Hello, I'm Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're here every Sunday morning, 6 a.m., and of course we replay at 8:30 a.m. In addition to my TV show, I do a live 2-hour radio show throughout Florida from 10 a.m. on Sundays to noon. Go to my website, reznywealth.com, for times and availability. And as always, we will be taking your questions. If you want to send those to Brian Rezny at reznywealth.com. If you have retirement questions, investment questions about mutual funds, stocks, bonds, maybe you're questioning the advice you're receiving. Do you have a real money manager who's working in a fiduciary capacity, or do you have a Wall Street salesman and you're concerned? Often investors don't know the difference. So if you have a question, what I find is smart people ask questions. Send us your question to Brian Rezny at reznywealth.com. We want to make sure you can make better decisions around your portfolio so you have a more secure retirement. You know, I want to talk a little bit about the economy, of course. We're into the second quarter of 2015. Economy, generally speaking, looks pretty good. I get a lot of calls and questions, not only on my TV, but my radio show in addition, about the economy. Is the economy really growing? I hear all this gloom and doom all the time. What about the stuff going on in the Middle East or Russia? Should I be concerned? These are geopolitical events, and folks, I can tell you this. I've been managing money for 28 years. I've been through all kinds of geopolitical events. Over the last 2,000 years, we've had all kinds of geopolitical events. At the end of the day, geopolitical events are going to be a natural part of the process. It's going to happen. You can't avoid these. If you're a short-term investor, you're worried about the next week, you should have cause for concern. But if you're a short-term investor for the next week, you shouldn't be invested anyway. But if you're an investor for the next 1, 2, or 3 years, you're 70 years old and you've got a 20-year life expectancy ahead of you, don't worry about geopolitical events. You can't really plan around them. All you can do is properly position your portfolio so you can make total return and have a secure retirement. When investors are too conservative, they're putting themselves at retirement risk. One of the big things that I'm seeing a lot in the last 3 to 5 years is too many investors being too conservative, holding way too much money in cash, waiting for the next market crash that's not going to happen, listening to negative headlines in the newspaper or the news all the time and thinking the world's coming to an end. I am finding a lot of retirees and pre-retirees alike are being too conservative with their portfolio. Let's take somebody 65 that's married. There's a 90% chance that one of you will live into your 90s. That's 25 years in retirement. Think about that. You need to grow your money and produce income, increasing over time in order to combat inflation. If you're too conservative and you're a long-term investor, like my example, you're not going to make enough money and you're going to drain your portfolio and it's going to hurt your retirement, and maybe you'll be back at work at the age of 80. Nobody wants that. You don't want to be too aggressive either. You want a proper allocation. But being too conservative is going to hurt your returns and ultimately your retirement. Investors fly away from U.S. stock funds at the highest rate last seen in 2009. What does that mean? Investors are running away from equities or equity stock mutual funds at the fastest rate ever. Why are they doing this? Because maybe they're scared and they're trying to be even more conservative. Folks, the economy in the U.S. is growing. GDP is expanding. The consumer is paying down debt. Corporations have the most amount of cash and the least amount of debt in corporate history. Earnings are growing. Remember, what drives the economy is growth of population. GDP growth, meaning they're selling more goods and services, which translates into more earnings for corporations. If that continues, and we're seeing all signs of that, that has an opportunity for investments to go up in value. Being too conservative and putting too much money in bonds is a risky proposition for your retirement. Retirees have way too much money in risky bonds. Risky bonds could be long-term treasuries that are 30 years in length. The longer the maturity, the more risk you have in bonds. You could have muni bonds that have long-term maturities. You have a lot of risk, meaning interest rates go up and down. Your principal value can go up and down a lot. Maybe you have too much money in high-yield bonds. That's one of the riskier places in the bond market, in my opinion. At the end of the day, understand that bonds are a cushion for short-term needs. Having too much money in bonds, usually more than 3 to 5 year needs, in retirement is going to be detrimental to your return. Again, you're 65, you have a 25-year retirement or longer. You want to make sure you have a chance to grow your money, grow your income to combat inflation. By buying too much in your portfolio in bonds is going to give you substandard returns below taxes and inflation, and it's going to ultimately harm your portfolio. Why you need an adaptive investment strategy, and I talk about adaptive all the time on my show. All adaptive means is you're not trading all the time, but you're making adjustments to your portfolio as the economy and the investment markets change. Guess what, folks? Interest rates used to be Jimmy Carter day here. Now they're way down here at 2% on the 10-year Treasury. The bottom line is rates can't go down as much as they did over the last decade. It's impossible. But they can go up. As rates move up, bond investors could lose a fortune. The longer the maturity bonds you own, like a teeter-totter, bonds go down when interest rates go up and vice versa. Understand the maturity of your bonds, understand how much bond exposure you have, and if you have too much in high-yield bonds, I think that's one of the biggest traps a lot of retirees are currently taking. They're looking for yield, they're stretching for return, they're buying things that are risky investments that produce higher income, but when you lose a lot of your principal, what's going to happen to your retirement portfolio? Review your bond portfolio and your income investments and make sure you have the right things in your portfolio. Phil from Davie, Florida. Which investments could benefit from rising interest rates? That is an excellent question, Phil, and I'll tell you what. I firmly believe that rates are going to slowly move up. They're not going to move up fast. Maybe we get a quarter point this year, a quarter point, half point next year, but I think they're going to slowly move up as long as the economy stays on the glide path on the upside. Investments that actually do well in a rising interest rate environment. Floating rate securities do well. These are floating rate bonds, can do quite well. Stocks can actually do quite well if interest rates rise slowly, and that's really what's anticipated. If you listen to our Fed chairman, she's basically stated, we're looking to raise rates, we're going to do it slowly, and we're going to do it as needed. So the bottom line, again, if the economy grows, expect higher rates. Stocks can do well. Floating rate securities do well. We like both of those, and we actually own both equity and bond floating rate in our portfolio currently. I think it's a smart place for investors to have part of their allocation if they're trying to protect against a rising interest rate environment, like what would happen to bonds, protect the downside, have some upside potential, and interest that could actually increase over time. Larry from Boca Raton, Florida. What is the future of small cap value premium? Larry, you're probably talking about that traditionally small cap stocks have a premium or overvaluation and a return that's actually outperformed, let's say, large cap S&P stocks. That's happened for the last couple decades. Generally speaking, rule of thumb, small caps outperform large cap about 80% of the time. So that means small caps underperform large caps about 20% of the time. Back in 2014, last year, small caps lagged S&P large cap. As of the end of the quarter of 2015, small caps were up around 4%, and large cap was only up 0.5%. I've talked about investors on my radio and my TV show, and I've urged you to take a look at small and mid-cap stocks, which have had great outperformance in our client portfolios for the first quarter of 2015. That may not continue, or it could. All I can tell you is this: small cap companies have a great opportunity to grow earnings faster than large cap companies. They can be bought out by large cap and mid cap companies, which often will buy out at a premium. We like small cap as long as you're not a 1 week investor. If you've got money that you're investing for the next 3 to 5 years and you're a retiree, having some money in small and mid cap in the U.S. makes a ton of sense. We've owned them for a number of years, and it's definitely benefited our client portfolios. Rich from Cape Coral, Florida. Burger chain Shake Shack, SHAK, went public. What do you think? I would avoid this stock. General rule of thumb: I do not like IPOs or initial public offerings. And the reason I don't, the vast majority, probably 70-80% of these things, do just tank and do extremely bad performance the next 12 months and often the next 3 to 5 years. A big percentage of them. There is a small percentage that do quite well. The problem is, how do you pick the real good ones from the bad ones? I would avoid IPOs for the first year they come out. This way you've got a year they can trade, you can watch the trading track record, you can get better financials on these stocks then. If it's going to be the next Microsoft, if Shake Shack's going to be the next Microsoft for the next decade and it's going to go up 2,000%, you can always jump into it then after you get a better trading volume and better research and kind of see how the company's doing versus jumping in on day one. Another way to do it is you might look at one of the ETFs, exchange traded funds, FPX, which for disclosure, we do own that currently at Rezny Wealth Management, and our positions can change anytime. It actually buys a basket of IPO stocks. This way you've got a broad basket instead of buying one or two, and maybe those one or two do very poorly and you lose a lot of your money. Be diversified. Look at ETFs that buy IPOs. I think it's a better tool in your portfolio. Bob from Chicago, Illinois. I have $300K. I'm getting zero interest and I'm happy about that. The bank has a brokerage division and I am considering moving my whole amount to brokerage. What do you think? Bob, if you take your money and move it to the brokerage side of your bank, you are responsible to manage your own money. Let me tell you what happens with most investors. When you go over from the teller to the guy who's got the nice suit on and he works in the bank and he's a broker, he actually works for the bank's brokerage department. He actually doesn't work for you. If you open a brokerage account, that's under suitability. He'll show you investments that his firm offers that he's required to sell, not the best investments, not the cheapest, but Bob, you are required to develop your own investment strategy and monitor those investments. If you are unable to do that, find a fee-only fiduciary money manager that actually legally works for you and actually can manage your money. The vast majority of investors, 9 out of 10 investors think their broker or so-called advisor is managing their money when they really have a brokerage account. So in a brokerage account, you're responsible. If you want managed money, you want an advisory account. The only kind of firm you should ever entrust your money to is a fee-only fiduciary money manager. This way you have a firm that's actually managing your money and working in your best interest. If you want to learn more about that, by the way, go to my website, reznywealth.com. Download my free report, Fiduciary versus Suitability. It's your #1 investment risk every investor takes every day, and you don't even know it. Download the free report. It's groundbreaking. You'll learn a ton, and then you can decide who to entrust your money to once you read that free report. I'm going to go to a quick break. We're going to take more of your questions. You can send those to Brian Rezny at reznywealth.com. You can also visit my website, reznywealth.com, download any of our free reports. You can also send us email questions that we can read and answer on my TV or my radio show. You can also sign up for a consultation with my firm right there. I'll be right back after this message. Hello, this is Brian Rezny. If your goals are to increase your retirement income and retire without stress, go to my website and download our groundbreaking free report. This free report covers the investment and retirement pitfalls that are often overlooked even by the smartest investor. If you're concerned about outliving your money during retirement, or maybe you want to make sure you're not leaving money on the table, this free report is for you. Know the facts. Your retirement depends on it. Go to my website, reznywealth.com, and download your free report right now. And we're back, and I hope you're enjoying today's program. Of course, if you have any questions, send them to Brian Rezny at reznywealth.com. We'll answer those questions on my TV or radio show. Remember, following this program, 10 a.m. to noon Eastern throughout Florida, I do a live radio show in addition. Go to my website for times and availability. Of course, if you're concerned about your portfolio or you have concerns, maybe you're questioning the advice you're receiving, maybe you're questioning the return you're receiving on your money, or maybe some of the things I'm educating you about on my shows is starting to put up a red flag, call my firm for a consultation. We do an exclusive 21-point strategy analysis on your portfolio. Maybe a financial checkup, a review is exactly what is needed to help improve your portfolio. We can look at all your investments, find out the pitfalls, give you great ideas, and really help put you in the right direction so you can have a more secure retirement and ultimately make better decisions around your portfolio. Go to ReznyWealth.com to sign up for a consultation via email, or you can call the number at the bottom of the screen. As long as you call, get your questions answered. Smart investors know sometimes you need to get that question answered, get that second opinion, get your retirement moving in the right direction for the first time and the last time. Sally in Fort Myers, Florida. I panicked and sold out 4 years ago with my retirement portfolio. I thought things were headed for a larger correction in the stock market. How does one get back in now? Sally, I get a lot of questions throughout the year, similar situation as yours, where people, heard something. Last year was the Ebola virus in 2014. I had people calling my show constantly how they liquidated their portfolio because they thought Ebola was going to be the next Walking Dead TV show. The bottom line is this. You want to avoid negative headline news and negative headlines in general. Look at the facts. If the economy is growing, if earnings are growing, and we're not in a recession, you don't liquidate your portfolio. What you need somebody to actually help manage your money. What I find is very effective is this. Most people who manage their own money, unfortunately, do not do the best job at all. You can look at a lot of statistics on that because they tend to be a little more emotional. They go to cash. So you went to cash 4 years ago. You might have given up a 60 or 80% return on your portfolio because you went to cash exactly at the exact wrong time when things were starting to move back up. Investors often put too much emotion into their decision or their opinion. Neither opinion nor emotion is involved in a real investment strategy. And I will tell you, at my firm, I've been doing this for 28 years, we don't allow emotion or personal opinion to supersede a sound investment strategy. Neither should you. But too many investors today are in the same boat you are. I would suggest you get some professional help. Call my office. Our number's at the bottom of the screen. Give us a call. Go to my website, ReznyWealth.com. Schedule a consultation. Let's take a look at what you're doing. We can put together a solid plan of attack so you can make better decisions and hopefully not go to cash at exactly the wrong time. It happened to a lot of people. Unfortunately, that's going to be fairly devastating to a portfolio, but you can get yourself back on track with proper guidance. That's one of the main reasons people hire our firm every day, is because they want somebody to keep them on track so they don't sway off and make bad decisions. Eric in Boca Raton, Florida. I own GDX and GLD for about 15% of my portfolio. I'm nervous about asset protection against inflation and our government. What are your thoughts? Eric, I would not own GDX and I would not own gold, which is GLD. GDX buys the gold miners and GLD buys physical gold. These are both ETFs, exchange traded funds. Your basic premise is that you're afraid of the government and you're afraid of hyperinflation. I can tell you I hear this a lot from investors. Investors think there's some weird thing going on with the government where they're going to come in and steal all your money. The world's going to come to an end, and if I own gold, I'm going to be protected. The bottom line is this. You're in the safest place in the world being in just the U.S. economy itself. Our government is not a bunch of renegades. While they do a lot of inept things from time to time, generally speaking, our economy is doing well. So I don't see the world coming to an end, and you owning GDX, which has been a huge negative performer the last 3 years. In fact, it's down about 50% in 3 years. 50%. Gold's down about 35%. If you look at a chart on both of these, they're in a negative downtrend. I would sell both, take your tax loss, and move on. And what I would suggest is you need to develop a real investment strategy that not only shows you what you should buy and when you should buy, but more importantly, when do you sell? If you had a sell strategy in your investment strategy, you would have not owned GDX or GLD as long as you have and suffered those horrific losses. Move on, take a tax loss. Sometimes it's better to admit you made a mistake and move on to greener pastures. You'll be better off. Steve from Miami, Florida. I heard your opinion on high yield bond funds. What are your thoughts on bank loan funds? How does a fund like that compare to a high yield fund? It's much different. First off, high yield bonds or high yield bond funds traditionally are your riskiest kind of bond you can buy. And traditionally, high yield bond funds have maturities that average anywhere from 5, 6, 8, 10, 15 years in length. Valuations on high yield bonds in general are extreme. People have been flocking to high yield bonds and bond funds, pushing these values up. In fact, if I look at the general investment marketplace and I look at different sectors, utility stocks, in my opinion, are overvalued. I look at high yield bonds, extremely overvalued. If I look at publicly traded REITs, overvalued. Those are three areas I would really be avoiding, especially if we start to see a rise in interest rates. These are both going to get hurt. By the way, high yield bonds in general have a very close correlation to the stock market, but they actually show lesser return. The time to own high yield bonds or bond funds is coming out of a recession after the typical fall is over 50%. Own them usually for the next 3 to 5 years coming out of the recession, and then shift in other asset categories after that. High yield bond rates right now are around 4%, some of the lowest in history, meaning valuations are stretched. And if things do get frothy or we have a recession, high yield bonds, in my opinion, are going to lose a fortune. I would avoid them. But bank loan funds float, short-term duration, usually 90-day paper, much more appropriate in the current interest rate cycle versus high yield bonds. Joan from Plantation, Florida. My financial advisor wants me to invest in a non-traded REIT. I heard you say previous show that non-traded REITs are toxic and should be avoided. Also, what is the difference between fee-only and fee-based? Great question. First off, never buy a non-traded REIT. These are sold by brokers. The only reason they sell them is the lavish commissions they make. Most of these non-traded REITs take an automatic haircut off your portfolio of about 20% of your money. It's gone. Goodbye. It's not in your portfolio anymore. You invest $100,000, do you want to give up 20% of your money from day one? It's crazy. The broker doesn't explain that to you though, but that's typical on a non-traded REIT. Too many investors don't read the fine print, and the broker doesn't tell you the facts so you can make a better decision. Avoid non-traded REITs, better yet fire your broker. The difference, second question, difference between a fee-based and fee-only. Fee-based firms, brokerage firms all do fee-based work now. Their conflicts of interest can overlap their fee-based work. Bottom line, you're still working with a brokerage firm that has all the conflicts of interest and high cost. A fee-only firm works 100% fiduciary, and that's the only real true fiduciary, works 100% fiduciary in your legal best interest and is only paid by you, the client, to manage your money. They don't get kickbacks and sales trips and 12B1 fees and revenue sharing. The bottom line is fee-based is still in the brokerage arena with all the conflicts. If you're going to hire a firm, you should only hire a fee-only firm. If you want more information on that, go to my website, reznywealth.com. Download for free our groundbreaking report, Fiduciary versus Suitability. It is your number one risk, and most of our TV and radio listeners are making this mistake, falsely believing all firms have to work in your legal best interest and actually manage your money. Go to reznywealth.com. You will be glad you did. Al from Cape Coral, Florida. I was at a dinner seminar and pitched an equity index annuity with a bonus of 8%. With a bonus and an 8% return. What are your thoughts? I'm glad you enjoyed the free dinner, and that's all you should take from the free dinner. Anybody who goes to one of these free steak dinners or free dinners, period, you should realize you're going to hear a sales pitch usually on an annuity. The person giving you the pitch probably knows very little about the product. All that he knows or she knows is that they're going to make a big, gigantic commission. Avoid equity index annuities. Avoid all annuities in general. They come with huge, stiff penalties to get your money out. That bonus that person talked about, there is no free money bonus, and there's no 8% returns with any annuity. There's your real money, and they put that bonus or 8% on the hypothetical, I call it the fake pot of money. And by the way, those bonuses and those 8% returns, which is really an income rider, there's a stiff annual expense ratio for each one of those that comes against your real money and your real return. At the end of the day, if you buy an equity index annuity, or better yet, if you're sold one of these, you're going to insanely lock your money up for periods often 8 to 22 years in length, surrender penalties up to 22% to get your own money out. That is crazy. High expenses, low returns, and 2 to 3 years into it, you're finally going to realize you made a mistake, but you can't get all your money out unless you want to pay a huge penalty back to the insurance company. Don't be sold an annuity Don't go to a free dinner seminar unless you realize all you're going to be doing is being pitched an annuity that is not good for your wealth. You know, by the way, I get a lot of calls and questions on annuities all the time. Statistically, one of the biggest consumer complaint investments out there are about annuities. I know there's a lot of people that push them. There's a lot of deceptive sales practices around annuities. Too many investors don't read the fine print, and if you did, you might not understand it, because often the prospectuses these things come with are as thick as a phone book. Anything with high expenses, complex, and back-end loads never belongs in your portfolio unless you want to make the insurance agent more money than you and the insurance company more money than you. Avoid annuities at all costs. You know, I'm running close to out of time. I want to talk just a little bit about strategy going through the second quarter of 2015. A lot of investors, again, are far too conservative with their portfolios, especially retirees and pre-retirees. I'm finding a lot of investors don't understand the difference between bonds, stocks, real estate, oil, gold, or other asset categories. But investors think bonds are ultimately safe. Remember, folks, bonds have a lot of risk to them. All bonds, even government treasuries, can fluctuate in value, and they can fluctuate in value widely. As an investor, you need to realize if you are 65, if you're 75 years old, you could have a retirement that can go another 25, 20 years in length. You need to make a return on your money above inflation and above taxes. Too many investors are being too conservative today, overloading the boat in bonds and not having a proper allocation to areas that can truly grow. Two areas that I find often investors miss out on is small and mid-cap equity portions in the stock market. These are the true growth drivers of our economy. Look at your portfolio. Do you have any small or mid-cap exposure? Is it 1, 2, or 3%? That is not enough. Remember, yesterday's winners are not going to be tomorrow's winners. Look for companies that are smaller, mid-sized, can do the heavy lifting and give you an opportunity in your portfolio to push it to the next level. Diversification matters, but be in areas that can truly grow, give you a return on your money, and give you dividend or total return. That way, you'd have a much better chance to grow your money for retirement and have a more successful retirement. If you have financial concerns, if you're not happy with your current advisor relationship, call my firm. Get a second opinion. It doesn't hurt to talk. Make sure you have yourself a safe and profitable day.